I'm Michael Andersen of Andersen Wealth Management, and I would like to present a topic that should be of interest to you: how you can keep your retirement account in the family, pass it on to future generations, and thereby create a family legacy. This video contains several examples of what can go wrong if your retirement accounts are not set up properly. I encourage you to spend the time to learn how these issues could affect you.
Do you own a retirement account such as a 401k, IRA, TSA, 403b, or a deferred compensation plan? If so, you should be aware of one of the biggest tax traps and lost opportunities within the portfolios of Americans today. In order to explain this, we have to go back in time. Prior to 2001, when the owner of a retirement account passed away, their designated beneficiaries were required by law to take either a one-time lump sum payment of the remaining IRA funds or make withdrawals over a 5-year period. That meant the beneficiary would be taxed at his or her current tax rate at the time of the lump sum payment or during the 5 years of withdrawal. Assuming that beneficiary was most likely the son or daughter of the IRA account holder, that meant the beneficiary was probably in their prime working and tax rate years. So, the lump sum payment or 5-year withdrawals would be taxed at a relatively high rate. But 10 years ago, in 2001, the Internal Revenue Service made it possible to have stretch IRAs, where individuals could pass on their retirement accounts to future generations without the requirement of a lump sum payment or 5 years of withdrawals. Why was this important? Because by eliminating the lump sum payments and 5-year withdrawal requirement, it became possible for the entire account balance to be passed on to the next generation without Uncle Sam taking his percentage. Keep in mind that this change by the IRS, allowing stretch IRAs, didn't just happen. No, it occurred in 2001. And it's amazing how individuals and their advisors or brokers do not understand the missed opportunities or consequences that will occur if the paperwork is not set up correctly. When that happens, the results can be devastating. Devastating in 2 ways. First, if by chance the accounts are not passed on properly, the full tax can still be due. And secondly, in lost opportunity. What's meant by this? Lost opportunity in making these stretch IRAs multi-generational and allowing both children and grandchildren or other loved ones to participate. The difference, as you'll see in a few moments, can be incredible. So how do you understand if your account is set up properly to pass on to future generations? It can be a bit complicated, so let's begin with the basics. If you're the owner of a retirement account that we defined earlier, these accounts all have one thing in common. The assets inside them have yet to be taxed. I'm not talking about just any tax. I'm talking about ordinary income tax, a progressive tax that increases as your income increases. In other words, the more funds that are withdrawn from your retirement account, the more of those funds that will be taxed and given to Uncle Sam. It's a simple concept. When you opened your retirement account, you basically made Uncle Sam your partner in the account, and part of that account belongs to him. Uncle Sam sets the rules. And one major area of concern given our spiraling debt and unfunded entitlement programs is Uncle Sam is able to vote himself a larger share of these accounts. How? By increasing taxes. That is a topic discussed on another video. However, every person with a retirement account should be very concerned about this risk and looking for strategies to protect their savings. Another advantage Uncle Sam has is that he gets to tell you when and how much you must withdraw from your account. This is known as a required minimum distribution, or RMD. RMDs begin at the age of 70 and continue until the death of the account owner or when the account balance is exhausted. The RMD can cause lots of problems. The biggest problem is that it causes your Social Security benefits to become taxable or move you from one tax bracket to a higher tax bracket. Most retirement account owners do not want to make withdrawals from their accounts, so they just follow the required minimum distribution schedule exactly. By doing so, it means they will likely have a sizable balance in their account at the time of their death. This is when things can really go wrong, and mistakes can be made at that time that can be impossible to fix and can result in a tax that could potentially see 40% or more of their IRA go to the IRS. So how can you avoid this problem and do what most people want to do with their retirement account? And what is that? Keep it in the family. Let's start with an example from an article in Money Magazine entitled "From Debtors to Millionaires Overnight." This article is a tragic reminder of what can happen if things go wrong. It talks about a 63-year-old who had accumulated $500,000 in his 401k account and died unexpectedly. His son was the only beneficiary and had no idea his father had saved this much. The father was a meter reader and lived modestly. In other words, he saved and sacrificed for a secure financial future for himself and had his account set to pass to his son upon his death. However, before the son could receive his father's retirement account, he had to pay $230,000 in taxes. Effectively, 46% of the 401k account was lost to taxes. Here's another way to look at it. Several years of work and sacrifice by this hardworking gentleman were lost to an unnecessary income tax. How long did this man have to work to accumulate $230,000 in his account? Unfortunately, it was gone in one day. This tragedy didn't have to happen. All of this man's work and sacrifice could have been passed on to his family. The article goes on to tell us the son wanted to give each of his young children $100,000 from his dad's estate to pay for college. Unfortunately, that money went to pay taxes and not to the grandchildren. One could certainly assume this grandfather would have preferred that his grandchildren receive the money instead of the IRS. In other words, he wanted to keep it in the family. This is a sad example of why it's so important to make certain this part of your financial plan is in order. So how can you make certain this doesn't happen to you? There are 3 critical elements to making sure you keep your account in the family. The first is the custodian of your account. In other words, the company your funds are invested with. The second is your financial advisor. And the third critical element is the beneficiary document, which determines who receives these funds upon your passing and how they receive these funds. As you'll see, the argument can be made this document is the most powerful document inside your estate. It trumps everything else. Let's begin with the first critical element in the mix, the custodian of your account. The question you need to ask yourself is this: is your custodian equipped to administer a multi-generational IRA? Believe it or not all companies that act as custodians are eager to administer a multi-generational IRA. Remember, the multi-generational IRA allows multiple generations to benefit from the account. Over time, they will experience the 8th wonder of the world, compound interest. How? By keeping the money in the family and away from the government, allowing it to continue to grow and grow. Let's take a closer look. In 2001, the IRS ruled that IRA accounts could be passed on to future generations without the requirement that the beneficiary take a lump sum payment or 5-year withdrawal at the time of death of the account holder. Well, the IRS also ruled that those beneficiaries of an IRA account could begin using their own age and life expectancy to make withdrawals from their parents' accounts. This is critical because the required minimum distribution schedule the beneficiary follows is based on their life expectancy. In the example we just used, the son of the 401k owner was 37. Meaning his life expectancy is 40 more years, and he can now take required minimum distributions from his dad's account beginning the next year and continuing for the rest of his life, meaning all of his dad's account is going to grow and pay the son an income for his lifetime. Although he has to make withdrawals each year under the required minimum distribution rule, the withdrawal is based on the son's age and not the father's age. And it is small considering the alternative noted earlier, $500,000 being fully taxed at an amount of $230,000 with only $270,000 left. If the son manages the account well and achieves a reasonable 6% return over his lifetime, his dad's account would be worth $3 million over the son's 40-year life expectancy. What a difference. But wait, the son didn't want to keep all of his dad's account, remember? He wanted to give $100,000 to each of his young children. Sadly, this is not possible in most retirement accounts. But one of the most powerful documents inside your estate makes this possible, and most advisors or brokers make a tragic mistake and make this impossible. Why is this tragic? Because Dad's IRA could have been worth not $270,000 or $500,000 or even $3 million. It could have been worth more than $10 million. How? Well, if the son could have given each grandchild $100,000 from their grandpa's IRA, the children could use their age to determine their required minimum distribution schedule. That's right, even a 2-year-old has to take an RMD from an inherited retirement account. However, since they're so young and their life expectancy is so long, the percentage they must withdraw is so small that the principal in the account can continue to grow and grow. Imagine Grandpa's IRA compounding for his grandchildren for 70 or more years. Talk about a family legacy and keeping the account in the family. That is what a multi-generational IRA is all about. But wait a moment. How can the son give part of his inheritance away without it becoming taxable? Here's a secret few people know. The son must be allowed to disclaim part of the inheritance, or the above example cannot happen. This is accomplished once again on this all-important document, the beneficiary form. Most people don't realize leaving your IRA to a trust can actually defeat everything we've just discussed, because every beneficiary must use the same distribution schedule as the oldest beneficiary. This robs the younger beneficiaries of their greatest benefit, time to let these funds continue to compound. Let's review. The first critical element to making sure you keep your account in the family is the custodian of your IRA. The custodian is important. After all, they have to be willing to administer the account. And your financial advisor, who is the second critical element in keeping the account in the family, is important because he or she must be trained on how to make all of this happen. Distribution rules regarding retirement accounts are very complex and are constantly changing. But there is a third critical element in the mix that can't be overlooked: the beneficiary document that spells out who will benefit from your account when you're gone. Quite honestly, you should be concerned if your broker or advisor hasn't already discussed this beneficiary document with you. This may be a key indication they're not someone who specializes in this type of planning. Without a properly structured beneficiary document, making all this happen is impossible. An old saying that still makes sense today is it's not what you make, it's what you keep. You may call your advisor after watching this video and ask them about this. They may assure you the issue has been resolved. It would be prudent to ask them to prove this to you by producing your beneficiary form and allowing a qualified professional to review it. Your beneficiary document sets the course of your retirement accounts for perhaps the next 2 or 3 generations. Yet, it's the most overlooked part of most people's estates. Here are 2 tragic examples of what can go wrong when a beneficiary document is not updated. An article from the New York Post entitled "Pension Pickle" reports the sad story of a New York couple. The wife worked for the New York school system, and early in her career, before she was married, she opened a retirement account and named 3 beneficiaries: her mother, her uncle, and her sister. The wife accumulated over $1 million in this account, and it was the majority of the couple's savings. Unfortunately, the wife died unexpectedly. Tragically for her husband, she never changed her beneficiaries on her retirement account. Imagine, All those years of work and something that could take a few seconds of time didn't get done. What happened? Well, her mother and her uncle passed away before her, but her sister was still alive. That sister was now the sole beneficiary of this 7-figure mistake. The article tells us the husband tried to correct the problem all the way to the New York State Supreme Court, but he was denied each step of the way. Why? Because the beneficiary document, the most powerful document in their estate, was incorrect and had never been changed. The bottom line? A lifetime worth of work and sacrifice went to the wrong person. Here's another nightmare example. It's illustrated by a January 26, 2009 release covering a ruling from the United States Supreme Court. In this case, a $402,000 401k went to the wrong person. This release tells us that William Kennedy had worked at DuPont for 34 years and built his retirement account up to $402,000. Unfortunately, he and his wife were divorced in 1994, and she signed off on any rights to his retirement account in the divorce decree. He wanted the fund to go to his daughter, Carrie Kennedy, upon his death, which unfortunately occurred in 2001. But guess what? Upon his passing, the funds were paid to his ex-wife, not his daughter as he had wanted. Why? Because he never changed the beneficiary document, naming his daughter as the beneficiary and deleting his ex-wife. This case went all the way to the U.S. Supreme Court that ruled the ex-wife should receive the funds because she was the stated beneficiary in the beneficiary document, even though the ex-wife had signed off on any rights to his retirement account in the divorce decree. The case was decided in 2009, 8 years after his death. Imagine the heartache, strained relations, and expense that could have been avoided by having a qualified professional check this critical estate document. Hopefully you have found this video to be informative, and you now realize the importance of proper planning, not only for yourself, but also to make certain what you've spent a lifetime accumulating can continue to do amazing things for your loved ones after you finish using these accounts. This type of planning does not take any control away from you. Just the opposite. It gives you full control. Please call the number shown here to review your retirement account beneficiary documents. You should make certain that you and your loved ones will benefit from this advanced planning technique, avoid a terrible tax trap, and the lost opportunity of keeping your hard-earned assets in the family.
Hopefully, you have found this video to be informative and you realize the importance of proper planning, not only for yourself, but also for your family. This type of planning does not take any control away from you, just the opposite. It gives you full control. Please call the number shown here to review your retirement account beneficiary documents. You should make certain that you and your family will benefit from this advanced planning technique.